Okay, let's get right into the closing print for Monday, December 22nd.
Yeah, let's do it.
The market, it was supposed to be a sleepy pre-holiday week,
Supposed to be.
but it delivered a certified trend day to the upside. But, the story is always a bit more nuanced than the headlines.
Always.
So let's hit the scoreboard first, and we can figure out who was actually driving the bus today.
Sounds good.
The S&P 500 finished the session up a solid 0.8%.
Right.
The tech-heavy Nasdaq Composite, it was the star of the day. It just soared, added a full 1.3%.
A huge move.
And even the Dow, usually a bit sluggish, managed to add 0.4%.
What's really fascinating here is how quickly the narrative formed. It was immediate.
Yeah, what was it?
The AI trade is back.
Yeah.
And it is roaring. This wasn't some quiet drift higher,
No, not at all.
This was a deliberate move. It was fueled by that distinct risk-on sentiment, the kind that just chases high growth, high multiple tech.
And that rotation was massive. You can't deny the sector leadership. Technology, I'm looking at the XLK ETF. It was the undisputed leader today, up 1.5%.
And on the other side of that,
The clear laggard was energy. The XLE was down 1.5%. That's a textbook rotation.
it is. It's a rotation out of inflation protection, out of old economy value.
And squarely back into growth. All based on this continued optimism for, softer landings and easier rates.
Exactly. It suggests the institutional memory of, those cooler inflation readings and the AI infrastructure story. It's just overriding the typical year-end slowdown, the money that stayed in the market. It chose a very clear direction.
Okay, so that's the setup. But before we get too excited about this close, we have to look under the hood.
Right.
Which brings us to the big question. Was this rally built on real conviction, or was it built on, frankly, thin ice?
And that's the key, because we are now officially in what the street calls the holiday float.
Right. For those who aren't on the desks, what does the holiday float actually look and feel like?
The holiday float it's a critical concept for this week. It's what happens when the big institutional money, pension funds, the hedge funds,
The real heavyweights.
they've essentially closed their books for the year. They're not putting on massive new positions. The desks are light.
So it's mostly algos and retail driving things.
Exactly, which means you get extremely thin market volume.
And we saw that contrast so clearly today. You look back at last Friday, there was undeniable conviction. Volume hit 24.60 billion shares.
Which is way above the 20-session average. That's
Yeah.
real confirmation.
But today,
Uh-huh.
the volume is just, it's not there. This is the official start of the float.
And that tells us something really important about sustainability. A huge move up, like we saw today, on thin volume. Historically, that's just not sustainable.
Okay, I have to play devil's advocate here for a second.
Go for it.
We know the institutions are mostly gone for the year, so shouldn't we expect low volume? Isn't that just normal? Are we reading too much into it?
That's a fair challenge. We do expect lower volume. The concern isn't the volume itself.
It's the move.
It's the size of the move on that low volume. When you get a trend day like this, without that institutional stamp of approval, it signals fragility. It potentially sets up for a sharp reversal when they come back in January.
So they might see this rally and just fade it.
Aggressively. They might see this light volume holiday rally as the perfect exit liquidity.
So if they aren't initiating big new positions, what are the institutions doing during this period, strategically speaking?
They're managing optics and liquidity. It's really two main activities. First, window dressing.
Ah, the classic year-end move.
It is. They're optimizing their portfolios for the year-end statements, selling the losers, holding on to the winners to make everything look good.
Making the Christmas tree look good for the photos, even if it's hollow on the inside.
That's a perfect way to put it. And the second thing, which is a bit more risky for everyone else, is using this thin volume as exit liquidity.
Right. Selling into the rally.
They're offloading positions into what is mostly retail buying, capitalizing on the strength by selling right into it.
So the retail buyer sees the S&P up and gets excited, while some big desk is quietly using that strength to lighten up their exposure.
Yes, but, and this is a key detail you cannot miss.
Okay.
This is where the real conviction lies. It's in the targeted buying. Despite the broader fade, institutions were selectively loading up on winners.
In which sectors?
The core AI infrastructure complex. We saw continued institutional inflows into names like Micron, MU, Western Digital, WDC, and Palantir, PLTR.
Now that is a story. So the indices are thin, maybe prone to a reversal,
Right.
but the real money is specifically getting positioned in those names, the names that literally power AI. That tells you where the long-term conviction is for 2026.
It's a critical distinction. They might be trimming the portfolio around the edges, but they're adding ballast to those foundational AI stocks.
That structural contrast is the perfect segue because we need to move from headlines and volume to the internals. Was this a real breakout or was this rally just dangerously narrow?
The S&P headline number is. It's profoundly deceiving. I think we have to assume today was a classic narrow rally.
So what does the breadth look like, the advanced decline ratio?
Well, despite the S&P closing up almost a full percent, it's very likely that we saw something like 1.5 stocks decline for every single stock that advanced.
That's the core divergence warning. It's the generals versus the troops.
Exactly.
The S&P 500, the generals, a handful of mega-cap AI names, they advance. They push the index higher. But the troops, the rest of the market.
The troops are retreating, and that signals deep fragility. A rally that relies so heavily on, 5 or 6 stocks, it's just so susceptible to sharp reversals.
If one of those generals stumbles, the whole structure is vulnerable.
It's the total opposite of sustainable market health.
And this fragility is being masked by extreme investor complacency. We can see it right in the volatility index. Assuming the VIX closed somewhere in that 13 to 15 range.
Which it did. That signals incredibly low expected volatility. The market is pricing in perfection.
And that low level is exactly what worries active traders. It's the calm before the storm.
It is. It means investors aren't paying for insurance. They feel safe. And when that complacency is coupled with the narrow breadth we just talked about, that's a dangerous mix.
So we have a weak rally on thin ice, plus investor complacency. But if we zoom in on specific tickers, the market is already screaming warnings and opportunities.
Right. Let's look at some key reversals from today.
Where do we start?
On the bearish side, you had to see the action in First Watch, ticker FWONK. It plunged 5.76% in pre-market.
And that selling just continued into the open, a really sharp reversal in sentiment.
And what's crucial about FWONK is that this wasn't tied to some bad earnings report.
No, it was macro. It was algorithmic, a shakeout that hints at broader sector fragility.
But on the flip side, we saw a huge bullish opportunity in Atlantic Lithium. It gave us a very clean, bullish island reversal.
For anyone listening, an island reversal is when the price gaps down, trades for a bit, and then gaps back up. It leaves that price action isolated like an island.
And that's a powerful short-term bottoming signal. It's the perfect bear trap.
Shorts get comfortable, then bam, they're forced to cover on the gap up.
Exactly. And one more, outside of equities, silver. XAGUSD.
What's the setup there?
It's showing a potential bearish reversal.
Yeah.
I mean, silver's had an incredible run, up 52% in just 2 months.
Wow.
But now it's hitting the very top of a well-defined parallel channel. That screams overbought condition.
So after a massive surge like that, hitting the top of the channel, probability favors some profit taking.
It's a risk management alert, a great spot to take profits or even initiate a short, anticipating a pullback.
Okay, so we have indices surging on thin volume, narrow internals, and key assets already reversing. This brings us to the look ahead. We've got Q3 GDP and consumer confidence data tomorrow.
And those data points provide the context for our main focus, the asymmetric trade.
Which is?
A long squeeze opportunity. Given the technical resilience and the short interest that's been building up, the risk-reward actually favors the upside if we hold key levels.
And to execute that, we have to know the single most critical level. Let's talk about the technical floor, the gamma wall.
The absolutely crucial level for the S&P 500, for SPX, is the gamma wall. And it's sitting firmly at 4750.
So just a quick refresher on the mechanics there. Why does a massive amount of put open interest create a magnet at 4750?
It's all about dealer hedging. The options market makers, they are short all those puts. So as the market price drops towards 4750, the math requires them to buy S&P futures to hedge their risk.
And that forced buying creates a technical floor.
A substantial technical floor, and it acts like a price magnet.
So that defines our risk reward perfectly. A daily close above 4750 keeps the constructive long squeeze outlook in play.
But a failure to hold 4750, especially on higher volume, would invalidate that long thesis immediately. It signals accelerated downside. And we should also note 4780 is our short-term call resistance, the immediate ceiling.
Speaking of continuation, today was a strong trend day. What does history tell us about what happens on day 2?
Historically, strong trend days have significant follow-through. The probability of a trend day continuation, or at least a consolidation near the highs, It's around 70 to 75%.
So the implication is you don't aggressively fade a trend day like this one right away.
No, you look for minor dips as buying opportunities.
Which leads us directly into our day 2 plays.
Let's start with setup 1, playing off that AI theme. Quantum Innovations, ticker QAI.
What's the story there?
The stock closed up a massive 12% on just phenomenal volume. It broke out of a multi-month consolidation pattern thanks to an analyst upgrade and some patent news.
So what's the actionable level for a follow-through? How do you get in without chasing?
You look for an entry near today's breakout level, which was $150. If it retests and holds that level tomorrow, that confirms the breakout is legit.
And the target?
Initial target would be toward $165, with your risk defined tightly below $148. Confirm the breakout, don't just chase the high.
I like that. Okay, setup 2.
Global EV parts, GEVP. It shows signs of strong institutional buying.
Right, it gapped up 8% on that strong Q4 pre-announcement.
Exactly. And the fact that it closed near its absolute daily high, that's a classic sign that institutional money was buying all day long.
So for tomorrow, we'd watch for a flag formation or a slight pullback to the open, around $72.
That's the play. That open price often acts as magnet support on day 2. If volume confirms the dip buy, we target a push toward the $78 to $80 range, but manage that risk below $70.
So these plays are capitalizing on that high continuation probability, but you have to be strict with the risk management.
Absolutely. So as we wrap this deep dive, the key takeaway for you is vigilance. Don't be fooled by the headlines. The market's health is fragile.
Because of the narrow breadth and the thin holiday float.
The generals are carrying way too much of the weight right now.
Which means the single most important level to watch tomorrow, the technical make or break point, it's still at that same number.
It's the SPX gamma wall at 4750. How the market reacts to that level will define the entire risk structure for the rest of this week.
Okay, now for our final provocative thought for you to chew on tonight. Considering the low volume and the institutional window dressing, what does the specific continued institutional loading we saw in AI infrastructure names, Micron, Western Digital, Palantir, what does that tell you about where the real money is positioned for the first week of January 2026? Think about that commitment to the infrastructure names versus the lack of commitment to the broader S&P headline. What are they truly willing to own over the holidays?